Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
There are several obstacles affecting you having a successful retirement, but there's one that's going to shock you. Stick around for today's show and we're going to break it down for you. You're going to be amazed. We have a great show lined up today. Welcome to Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. As always, I'm with the big man, Big Al Clopine. He's sitting right over there. We're going to bring him on in just a second. But here's the story with you boomers. You're living in what is called a sandwich generation. What the heck does that mean? Well, you have elder parents that you're still taking care of, and you might have kids still on the payroll. Every money is going every which way but loose, but your retirement. That's what's on my mind today. So let me ask you a question. Do you think taking care of your grown children, your children that are grown are still on your payroll, do you think that is delaying your retirement? What do you think the answer is? The answer is a resounding yes. And so when you look at the statistics, here's the deal, is that if you are still taking care of your grown children, maybe paying their car insurance, taking care of their cell phone bills, you are pushing off your retirement. Just these little expenses go a long way. So you want to make sure that you take care of yourself first. Your kids are in your 30s and your 20s. That is jeopardizing your overall retirement. I'm going to bring on a man with experience with this to kind of break it down for us. Let's bring on the big man, Big Al Clopine. Big Al, you have two grown children.
I do, and neither one's at home right now.
Are they on your payroll still?
Thankfully. Yes, slightly. That's why I wrote this show, so I can figure out what to do.
Exactly. We're going to help you out, buddy.
Yeah, thank you very much. But Joe, you're right. There are obstacles, and I'm going to call these hidden risks that get in the way of your retirement. And really that first hidden risk that you may not be thinking about is supporting your children. Because when you're supporting your children, guess what? You're not saving near as much for retirement. It's going to delay your retirement significantly. Another risk is what we call sequence of returns. And this is when the stock market does not cooperate, does not do well as soon as you retire. And when that happens, like let's say you would have retired in 2008 and the stock market went down approximately 50%, it really jeopardizes your retirement. So we want to go over that and how to overcome that. We'll get into health care and long-term care. This is one of the more expensive parts of retirement because guess what? We need a little bit more health care as we get older. And finally, inflation. Inflation is one of those things that just keeps marching on, and it hurts our purchasing power. And Joe, I guess with these four hidden risks, if people pay attention to them, they'll be a lot better shape for retirement.
I mean, I guess one of the most hidden ones is people are still supporting their grown children.
Right.
And it's like, all right, well, here, do I pay for college or do I save for retirement? A lot of you are focusing on maybe putting the kids through school, and I get that. But here's something I got to ask you. Can you take a loan out for your retirement? The answer is no. So it's a balancing act to still make sure that you can provide for your children. I understand that, making sure that they get the right education and then that they're not out on the streets. But then again, wait a minute, where are you going to be 10, 20 years from now if you're not focusing on your overall retirement? So supporting the kids is one of these hidden risks that I think a lot of people don't necessarily look at. 6 out of 10 parents are supporting their adult children in all sorts of different variety of ways, such as...
in one way or another. And I think if you look at what the support is, I mean, probably the main one is cell phones. I mean, that's 36% of adults are paying for their adult children. But this list goes on and on. We get all the way down to car loan debt. There's a lot of ways that parents are supporting their adult children. And you know what? This is hurting their own retirement.
Big Al, what are some things that we can do to make sure that we're not doing this?
Well, I think right off the bat, let's charge our kids rent. And I have some experience with this. My 25-year-old Robbie, he came home for a year after college, charged them rent. Make sure they pay their car expenses, they pay their cell phone. And here's a good one. Make sure that they're performing gardening and maid services. That'll get them out of the house. And sure enough, now Robbie is out of the house. He decided to go get a master's degree, and now he's got his job lined up. He's got his job lined up, and anyway, so he's in good shape. And so I think.
So it was because of the gardening.
Yeah. It was actually he liked.
You got
a
couple calluses.
It was the maid service.
The maid service.
It's like, forget this. I'll live on my own.
Yeah, there you go. So I mean, just little things go a long way. Is that, yeah, it's fine to take care of the kids, but if they're still in their late 20s, early 30s, it might be time to give them the boot.
Yeah.
Right.
Well, that's exactly.
So, no offense, but that's the reality.
At least in my case, Joe. So what I did is I charged rent. It was relatively low.
What'd you charge him? A couple $100 or a couple thousand?
$300.
$300. Okay.
I mean, it's a start.
It
right?
is a start.
Now, if he would have stayed there another year, it would have gone up.
Oh yeah, what, $325?
Yeah, $310.
Let's get into a sequence of returns, because this is a real big problem when you're looking at saving money versus taking distributions from your overall portfolio. There's two different mindsets that you have to take a look at. Is that the impact of markets, all right? So if these two graphs are two different scenarios. One scenario is that someone retires in a bear market. The other scenario is someone retires in a bull market. Because when you start taking distributions from your overall portfolio, it has everything to do with the sequence of returns, not necessarily the overall rate of return. Because these two portfolios have the exact same average rate of return. But what happens is that if you have lower down years and you're pulling money out of the account, okay, so over a 20-year time period, both portfolios could average 6%. But it's when those returns hit. Because here's the math when it comes to taking income from retirement. If you have $100,000 saved, let's say the market drops 30% one year, but the market's up 30% the following year. So most people think, hey, well, I was down 30, I'm up 30, I'm good. No, the fact of the matter is, if you have $100,000 saved, it's down 30%, you have 70 grand. Then you have 30% on top of the 70, it's 21,000. You don't even have your capital back. And then if you're taking distributions from the account, it's very, very difficult to get caught back up. So if you retire in a bull market, right, your portfolio is growing. So you're in a lot better shape, but no one knows what's going to happen to the market. That's why you need to have a game plan. And so what are some things that you need to do is just to take a look at your overall portfolio. Do you have some safety in your portfolio? Are you making sure that you're pulling and taking that income from the right area when the markets are down? So there's a lot of different things that you have to consider in regards to the overall sequence of returns of the overall market, because that's where I think people are going to screw up. We've had a really good bull market out, and as people are transitioning into retirement, as we all know what happened in 2008, it jeopardized a lot of retirements.
Well, it did, Joe, and you're absolutely right. So the first step really is to make sure you've got a lot of safety in your portfolio. And what we like to recommend is that you have maybe 10 years or so of safety. So what that means is if you're spending, I don't know, $100,000 a year, you got $50,000 of Social Security, you need $50,000 from your portfolio. And so 10 years at $50,000, that's $500,000. So that's about what you need to have in your bonds, in your safety, or in your cash, or your T-bills. Things of that sort.
Right, and you have to absolutely have to be flexible too in your overall savings. This 4% rule that most people heard of, don't take more than 4% out of your portfolio. But if markets go down, you want to make sure that, hey, you're adjusting with that. And sometimes some of you might have to go back to work part-time. Most people don't want to do that. You can adjust your spending a little bit easier than going back to work. So what we're trying to explain here is that, hey, sequence of returns, right? So when markets go down and you're pulling income from that overall portfolio could jeopardize your overall retirement. So if you don't have a game plan in place, you want to make sure that you do, because what we've seen from time and time again, our memories are very, very short. We've had a nice big bull market, but guess what? That big bear is going to come around the corner, and you don't want to necessarily be caught off guard. All right, hey, we got to take a break, but don't go anywhere. We have Jack Dugan. He's a senior financial advisor at Pure Financial Advisors, certified financial planner, been in the business a long time. We're going to break things down about another hidden cost that you absolutely want to make sure that you take advantage of, or at least you're aware of, not take advantage of the cost, but you're aware of the cost, because it could jeopardize everything. It's a huge cost. You want to be prepared, so don't go anywhere. Show's called Your Money, Your Wealth.
Hi, my name is David Cook, certified financial planner with Pure Financial Advisors. Now, did you know that most employers will match a portion or a percentage of your 401k? Now, that is going to be dependent on each plan. Each plan is a little bit different, and that formula is different, but sometimes it's up to 50% of what you are contributing to a 401k. So make sure you ask your employer what is a match and get that money, because that's free money for you.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here alongside Mr. Clopine. Hey, stick around this segment. We got Jack Dugan. He's a senior financial advisor with Pure Financial Advisors. We're going to break down a couple of different expenses that you want to make sure that you take a look at in retirement. But before we do that, let's get to the true-false question.
If I only spend 4% of my beginning retirement portfolio each year, I can virtually guarantee that I won't run out of money for at least 25 years. And I would start by saying that's absolutely false. There's no guarantees at all. In fact, 4% for many of you may be too high. We just talked about sequence of returns last segment. So if you retire and you go into a bear market, you're going to probably need to adjust your distribution rate. In other words, how much you pull out of the portfolio to cover your expenses. Plus, what about this? What if you're invested 100% in CDs? You're earning less than 1%. You can't pull out 4% of your portfolio.
Yeah, so the 4% rule, Al, is just basically a gauge, I think, is to help people to identify how much money that they need before they retire. So that you can just divide, right, how much is your shortfall that you need to maintain as a lifestyle, divide that by 4% or multiply it by 25 to give you a lump sum number. But once you retire and start taking the money out, you can't just put that on autopilot and take that 4% out. It'll blow you up.
Yeah, well, that's exactly right, Joe. So I'll tell you, I think the next thing that we want to talk about on the show is health care and long-term care. It's pretty expensive. I'm going to get rid of my notes. I want to show you guys something here, and that is this. So this is from Fidelity. The average 65-year-old married couple over their lifetime will spend an estimated $220,000 for medical care as well as insurance. And so you're thinking, well, wait a minute, I thought Medicare would cover everything. No, that's not true. Medicare covers a lot of things, but you may need supplemental, so you have to pay for that. And even that doesn't cover everything. So you got out-of-pocket costs, you may have prescription costs, you have dental costs, all kinds of things that you may have to pay. So I guess the reason we bring this up is you need to plan for this in retirement, and $220,000 is a lot of money. But that doesn't even include long-term care. What about long-term care? If you need to go to a long-term care facility, how much is that going to cost? Well, today, this is according to the Skilled Nursing Facilities Organization. It's on average nationally $6,753 per month. So what does that mean? That means about $80,000 per year. And look at this. These costs have been growing at about 5% for as long as we can remember. So if you just extrapolate that another 5%, look at what it's going to cost in 5 years, $8,000, $11,000, 20 years. Look at this. Almost $18,000 per year. This is a lot of money. Now, not everyone is going to need to go to these kind of facilities, but if you do, it's a huge dampening of your savings and your ability for your spouse to retire and for you to get the care that you need, possibly. So, Joe, I think because this is such a big expense, let's dive in a little bit deeper.
Yeah, I think most people are confused when it comes to long-term care. What is long-term care? Is it insurance? And what are the costs? What does it mean, right? Does Medicare pay for it? There's a lot of different questions and confusions, and more of you are going to have to take a deeper look at this because we're living a lot longer. And because of that, our bodies are kind of weakening, and you will need some sort of care. So I brought in Jack Dugan. Jack is a senior certified financial planner at Pure Financial Advisors. And Jack, let's talk a little bit more about long-term care, because I think a lot of times you hear that buzzword, oh, you got to be careful about long-term care. But really, what is it? What does it mean? And what should people be aware of?
Yeah, I think you're absolutely right, Joe, because a lot of people, and it's kind of an interesting fact that when the Affordable Care Act first came out, it had long-term care as part of it. And so I think a lot of people got confused thinking that, well, maybe at that point in time my insurance would be covered through that. Unfortunately, the long-term care portion of the Affordable Care Act was one of the first things that was eliminated. So you are truly on your own. A lot of people also think, well, I've got Medicare. Well, Medicare will take care of it. Not really. You're going to get about the first 100 days of skilled nursing care taken care of through Medicare. Then you're on your own. So it's a huge cost. And like Al mentioned, costs somewhere, and I understand the average here in San Diego now is about $82,000 a year. So that can be a huge cost that you better have some sort of a plan A or plan B to cover those expenses.
Right. I mean, then you got to take a look at the average stay, right? Is it 2 years? Is it 5? I mean, you got Christopher Reed that needed long-term care for quite some years, and then some other people might just go in for a couple of days. Well, first of all, long-term care, what does someone have? I mean, unfortunately, the body deteriorates as we get older. So what causes someone to need long-term care or a long-term care stay?
So what happens is there's an event that happens that determines that somebody can't do normal activities of daily living.
So, I mean, if I break my hip, am I going to a long-term care facility?
Not as long as you have a game plan of recovery on that. A broken hip's probably not going to put you. It could if there's no option for recovery on something like that.
So what do you mean by no option of recovery?
So if I'm in good shape and I have a broken hip,
I can heal.
And I can heal. I can get better.
But if I'm going to be bedridden,
or I have Alzheimer's, and the statistics now say that 40% of people that are in their 60s will need some sort of long-term care activity throughout their lifetime.
So $80,000, that's a huge expense.
Absolutely.
So what should people do to prepare for that? I mean, I know there's insurance.
Yep.
You could self-insure. Maybe you just call on the kids, right?
Yeah, well, that's, unfortunately, I'm afraid that might be some people's last option, is they are going to be somewhat of a burden on their children. But there are some things that you can look at, and I think like with anything, you've got to analyze what's the risk and how am I going to handle this, because maybe I don't need to transfer the entire risk over to an insurance company, because quite honestly, when you're looking at insurance now, the cost has become extremely expensive.
What most insurance carriers got out of the game, right?
Absolutely.
They're like, I don't want anything to do with this, because they're holding on to that insurance policy. They're not letting it lapse because they know, hey, there's a high probability I'm going to use this insurance.
The actuaries way underestimated way back when, because if you look at a cost of insurance, say for somebody, because the way you buy long-term care insurance is based on your age, how much money do you want to have in this pool to be able to use from? So you have a daily benefit, how long is it going to last, for 3 years, 5 years, whatever long term you want to buy, and then a cost of living adjustment that's going to be involved. So, but just looking at the cost, it's extremely expensive. A 55-year-old today, for a husband and wife, will probably cost about $10,000 to have a minimum coverage of $150 a day, which works out to be, and if they do it for 3 years, that's going to work out to be about $162,000. That policy today costs $10,000. 7 years ago, that same policy cost $2,000.
Right.
So the cost of waiting is extremely, so I mean, if you're thinking about trying to insure this, you got to do it today, because it's only going to get worse.
So you got three options, right? Is the transfer the risk. You want to might take a look at an insurance policy.
And you don't have to insure the entire amount.
Right. Or you might want to use your home equity, or
Yep.
maybe you self-insure with some assets.
Correct.
Or a combination of two, or maybe you go to the kids or some caregivers.
Yeah, and I think that's what we're all going to have to do, is get into some sort of a combination, because it's very difficult for people to insure it for the full amount.
Hey, Jack, if people want more information, where should they go?
Absolutely. More information about insurance or any financial planning needs, be sure to go to purefinancial.com.
All right, great, thank you.
You bet.
And I think the most important takeaway here is that you want to make sure that you have a game plan in place. So it's not necessarily purchasing the insurance, but having that meeting and saying, hey, if something were to happen to me or my spouse, this is the game plan, this is what's going to happen. Because the cost of insurance is going up. And then if you take a look at the cost of healthcare is increasing. And if you look at inflation now, inflation is a huge thing that people have to take a look at, not only with their goods and services, but also with healthcare as well.
Well, there's no question, Joe, and people think of as inflation, it's kind of like that silent tax. It keeps coming, it keeps rolling along. And just to give you a little example here, this would be like today, the dollar, what's that going to be in about 10 years? And this would be assuming about a 3% inflation rate, okay? So a dollar, or what expenses of a dollar would cost about $1.35. In 20 years, $1.82. So let's think about that. So in 20 years from now, you retire at 65, 20 years from now, you'll be 85, and statistically, you'll probably still be around. And so you were spending $1 for goods and services. Now you're spending $1.82. In real numbers, I'm spending $100,000 today. I'm going to have to spend $182,000 in 20 years from now just to get the same services, goods and services. So it's something you've got to bake into your plan, and it really is one of those hidden risks that's often forgotten, Joe.
You know, there's a lot of different things that we talked about. When we get back, we're going to take a quick break. First of all, I want to thank Jack Dugan for joining us, giving us a plethora of knowledge when it comes to long-term care. But I want to flip the show back to you, because we get a lot of emails each and every week of some questions that you want to make sure that we answer. So we try to hit everything with a broad brush, but I want to dive in right after the break to really get specific to your situation. So don't go anywhere. We got great emails once again this week. Show's called Your Money, Your Wealth. We'll be back in just a second. Hey, welcome back to the show. Your Money, Your Wealth. Joe Anderson, Big Al Clopine. Thanks for tuning in today. Hopefully you're getting a little nugget in regards to your overall retirement. Let's go to the true-false question, Mr. Clopine.
I'm in my 40s, so I can reach my investment goals without investing in the stock market at all. And I'm going to start by saying this can be true or false. We have a lot of people that come to us that have made money in real estate. They don't have any stock exposure, and they're just fine. They've created a lot of net worth. So in that aspect, you don't necessarily need to be in the stock market. But if you are investing in stocks and bonds without real estate or without other alternative investments, yes, you're going to need some stock market exposure. Otherwise, you're never going to have enough saved. You're not going to keep up with inflation. You're not going to reach those retirement goals.
Depends on how much money you have too, though, right?
Sure.
If you got a lot of money, right, you don't necessarily have to take the risk. That's why planning is very important to figure out what target rate of return. But I would say 99.9% of most people in their 40s, yes, because you have several years until your retirement date, is that some stock exposure, I think, would be appropriate to get you a rate of return that would outpace inflation and, of course, taxes. Al, let's kind of recap the show here. So what we've talked about is some hidden risks that will affect your overall retirement. And one of them is supporting the kids. Hey, get the kids out of the house. You're still spending a lot of money paying their cell phone bills, their car insurance. It's time to cut the cord. Also, sequence of returns. It doesn't matter what average rate of return that you are receiving on your overall portfolio. It's the sequence when those returns happen. We had Jack Dugan on. We talked a little bit about health and long-term care and how expensive that actually is going to be for you. And then, of course, inflation, the silent tax. So those are some different hidden risks that will definitely affect your overall retirement. So you absolutely want to make sure that you're prepared. Let's flip the show back to you. Clopine, let's get to some email questions.
All right, so this is going to be from Jim in Leucadia, and he says, when I retire at 65, my wife is the same age, where should I pull money from to supplement my pension and my wife's annuity to get the best tax benefit? That's a great question, Joe. We kind of get this all the time. So in other words, I've got some fixed income. Maybe I got $30,000, $40,000 from a pension. Maybe my wife has another $10,000, $20,000, $30,000 from an annuity. Whatever it may be, it doesn't matter. And I need another $30,000 or whatever the number is from my portfolio. You got to go to your tax return. You got to figure out what your tax bracket is. Look at line 43 on your tax return. That'll tell you your taxable income, and then look at the tax tables to figure out what tax bracket you're in. If you're in a low enough bracket, like let's say the 15% bracket, maybe you want to pull some more out of your IRA, for example, or perhaps maybe if you're young enough at 65, maybe you want to pull from your non-qualified account, non-retirement accounts, and do a Roth conversion to get some money into the Roth IRA tax-free in the future. A lot of possibilities with this question, but the most important thing is make sure you're factoring your taxes and your tax rate so that you get the right best solution.
Well, I mean, I think she's on the right track, Al, right? She's looking at, okay, well, where do I pull from to get the tax benefit? So she's on the tax track, which is very important because I think that's a step that most people miss. So it's a loaded question because there's so many different angles that you can take this, but looking at your tax return in your retirement distribution strategy is so key because then that tells you what tax bracket that you're in. That's going to tell you how much income that you pull out from whatever account is going to be subject to federal income tax. Let's go to the next one.
All right, next one is Elizabeth in Carmel Valley. And she writes, my spouse and I have several small 401ks from previous employers, and each one is held with a different investment company. Is there a benefit to rolling all of them into one IRA? What do you say, Joe?
Yeah, sure. I mean, I think that consolidation is always important because it's challenging. Let's say if you have multiple different accounts, how are you managing the risk? How are you rebalancing the overall portfolio? What we usually see is when people have several different custodians, there's a lot of overlap. And what I mean by overlap, you're holding the same investments in different accounts, and it doesn't really do you any good. That's not necessarily diversification. Also, when it comes time to take your required minimum distribution, so you want to make sure, do you have IRAs and maybe you have old 401ks, maybe you have old SEP or 403B plans, whatever it is. There's different laws and rules when it comes to required distribution. So consolidation makes sense in most cases just for the ease of creating that income, managing the risk, doing the rebalancing, and taking your RMDs.
Yeah, I would agree with that, Joe. And you're going to have two different IRAs, one for you and one for your spouse. So you can't roll them into one account, but that consolidation makes it a lot easier to manage. All right, let's go to our final question. This is from Ron in Santee. And he says, I have a 2016 target retirement account. I will be retiring next year. Should I move the money to a less risky account during my retirement years? Will I have to pay taxes on the money if I move it? I will start with this. If you roll it to an IRA, no, there's no taxes. That's just a roll into an IRA. You don't pay taxes until you actually take the money. But Joe, why don't you get into the target fund question?
Well, you know, when you take a look at target date funds, they're very, very popular. And I'm a big fan of target date funds when you accumulate wealth, right? Because it gives you the allocation. And really what it means is this, is that I'm retiring in 2016. So the overall company, if it's Fidelity, Vanguard, T. Rowe Price, whatever, they're kind of building that overall portfolio for you and you're managing your risk. So if I'm retiring next year, then the proportion of stocks and bonds, you probably have more bonds than you do stocks because you're approaching retirement the following year. But then once you start retiring and taking distributions, I'm not a huge fan there because I'd much rather control the risk on my own. Because of how mutual funds work, how they sell, and just the volatility of those funds, you could get a little bit more specific. You could get a better rate of return in most cases, and you can just control the risk. I'm a big fan of controlling risk once you're taking retirement income because, as we talked about earlier in the show, it's the sequence of returns. That means everything is you're pulling money out, the reverse dollar cost averaging can really jeopardize your overall retirement. That's it for us. We're going to have a great show lined up next week. Just you wait and see, Big Al. Do you know what we're going to talk about?
Yeah, we're going to talk about estate planning mistakes.
Estate planning. We got Tommy Lawler coming on board, so stick around for estate planning. For Big Al Clopine, I'm Joe Anderson. You just watched another episode of Your Money, Your Wealth. Have a great weekend, everyone.